All right. So in this investor workshop, we're going to do stock screening and how to find potentially good companies to look into and watch and potentially invest in. And what I thought we could do, this was a suggestion by Tomas, and it's great because you're a younger investor. That's awesome. And I'm going to go through kind of a train of thought, like the steps that I go through when I look at a screener. And then I thought, hey, let's do a screen that you're going to make all the decisions on. Okay. So I'm using stock analysis. And the metrics that I'm looking at are all important, but let's start with where you really should start, in my opinion, and that's with the sector. What is the sector? It's the type of company. Technology, communication services is the one that I picked. Now, I always recommend pick sectors, and a sector is a group of industries. Within technology, you have semiconductor, you have software companies, and so forth. But pick a sector, pick industries that you understand, that you can really understand if the business is good or bad. You can understand their financials. And most definitely, I understand technology and communication services. Communication services as a sector, that's where Google, Meta, Netflix, that's where they live. And communication services is also, like the video streamers, YouTube, Facebook, and so forth. So the thing that you can get out of hand on stock screeners is if you select all, based on my other screens, I get too many stocks and I'm all over the place. I'm comparing a software company versus a real estate investment trust. And it's like, you shouldn't compare those two. They're not similar. So I really, really encourage you to focus on, which which sector you want to look at. So it looks like my sector is gone. Let's go ahead and go with that guy. And here it is. Okay. So I'm just going to go with technology and communication services. These are probably the two sectors. First, technology is red hot, but I've worked in technology. I've worked in technology for a long time, and know software probably the best in technology. But I've invested and have done business with other technology players like semiconductor, infrastructure, and so forth. Communication services, I've been an investor in Facebook for a long time, as well as Google, and that industry is something that I've put a lot of time to get to know. So first and foremost, pick sectors and industries that you really understand. So that's the first step. Now that, okay, we're going to look at companies that we can really understand. Now, what are we looking for? Well, in my case, I wanted a lower PE, not a super low PE, like under 5. No, I thought, let's go under 20. I think that'll give me a list. I like free cash flow. And again, I'm not picking super crazy numbers because the combination of all these things is going to make the list short. So be aware when you're doing your screens, play around the numbers, but don't go too extreme, because if you go too high, you end up eliminating, stocks. And maybe if you have a list of like 50, you can keep making it harder or more constrictive on your screen. But for now, I just want to keep it at these particular ones. Revenue growth. I love revenue growth. So over 10%. I'm going to go with revenue growth over 10%. And then margin. I like margin over 50%. This is what I'm screening on. If companies match this criteria, they're probably going to be interesting for me to look at. And it gave me 4 stocks. In my opinion, that's a positive or a productive screen. If I got a list of 100 stocks, no, because I can't look at 100 stocks. And now when I look at this list, I'm like, okay, joint stock company, not sure what they do. So we'll take a look at that one. But this one really popped out at me. OpenText. I've heard of this company. It's a software company. So we're going to look at that one closely. Double Down Interactive. This sounds like gaming. And they're in communication services. And then Global MoFi AI. So let's take a look at all of them. And just kind of do just a quick little drive-by. Hey, what are these companies all about? So joint stock company is subsidiaries. It provides payments, marketplace, fintech solutions for consumers and merchants in the Republic of Kazakhstan. Interesting. So they're in Kazakhstan. Wow. I don't even know where Kazakhstan is. And I imagine it's in Eastern Europe. Go ahead.
I traveled to Kazakhstan, so I don't know this company, but it's very strange to me to see one Kazakh stock here.
Interesting. Cool. So I have nothing against Kazakhstan, but I'm going to eliminate this one because I don't know Kazakhstan. So I'm looking as, from an investor perspective. So we eliminated that one. Now let's look at OpenText. So OpenText Corporation engages in the provision of information management products and services. The company offers content services, including content collaboration and the intelligent capture of records management, collaboration, e-signatures, and archiving. Okay, so these guys help like companies that are creating websites or portals on the internet. They help in kind of putting all that data together, which is probably going to be really useful in the AI paradigm. Now, what is incredible is this has a low PE for a software company. Okay, this is a good business, software applications. So I've worked at a software applications company for 20 years, and before that, I actually worked with other companies where we implemented software. So I know software really well. The reason I was able to learn other industries is we would help companies that did pharmaceutical implement software. So we got to know their businesses. We got to know semiconductor. We got to know hardware companies, networking companies, Facebook, companies like that. So I really like this particular industry. And when we look at this company, it's this low market cap, 7.8 billion. And when we look at their growth, green on the screen, and look at these 2 years. Holy smokes, that looks great. Let's look at the quarterly. So here's where we're seeing a little bit of problem, right? In the quarterly, we see that quarterly they have a fiscal year, and their fiscal year Q1 for the fiscal year 2025 ended September 30th. Revenue is down 11%. So this one might be a really good stock for me to look at and get to know. And if I think this is going to be temporary and they're going to come back, this might be a really good investment. Let's continue to look. So then we got annual, back to annual. The margin, I'm trying to see gross margins. So gross margins of 76%. That is great. And then we have free cash flow. Free cash flow is good. So I'm really interested in OpenText, and we're not going to do a full evaluation of OpenText on this session. This session is about doing a screener, then gets me to a good list of potentially good stocks to follow or invest in. Okay. And here's one. Okay, great. So this screen got us to a list of 4. This one is not good for me because I don't know Kazakhstan. Okay, that's fine. Now let's take a look at Double Down Interactive. So Double Down Interactive engages in the development and publishing of casual games and mobile applications in South Korea. Interesting. It publishes digital gaming content. Double Down Casino. Okay. Interesting. Look at this PE. Incredible. And then forward PE is really low. So this looks really interesting as well, but I don't know Korea. So I'm gonna pass on this one because I'm not in Korea. I don't know if it's good or bad. Nothing against Korea. It's just I just don't know Korea. All right. And then the last one is GMM. So GMM MoFi AI, Global MoFi AI, through its subsidiaries, provides virtual content production, digital marketing, digital assets development services for the metaverse. And metaverse in industry of Republic of China. Okay. So they're doing VR, they're doing metaverse. Market cap 8 million. Oh, man, these guys are so small. Revenue's 34. They are growing, but these guys are super small and they're in China. So this one's out. So very quickly, I'm like, all right, great. I've got one stock that I can sink my teeth into, OpenText, and we went through that screen. So that's a stock screener. That's how I run a stock screener. So let's turn the tables, and I'm going to interview you, Tomas, and you're going to fill in the questions. So Tomas, which sectors are you interested in? Do you feel like if you looked at that sector, you would understand that those companies? You have all of them to choose from. Which ones do you like?
All right. Well, I think in technology, I'm thinking about companies that I use every day, like Google, Facebook, Airbnb, Uber. And I think besides that, what includes communication services?
So in communication services, Google, Facebook, Netflix, it's Disney, it is AT&T, Verizon, T-Mobile.
Okay. Well, I would say technology and communication because principally technology because I think it has the more growth horizon,
Mm-hmm.
And besides that's it.
Okay. So, all right, very good. So for an investor like you, where you're like, hey, I want to put money away, maybe 20 years later, wake up and see it that it's it's doubled four times, right? You took $100,000 and grew it to $1 million. So let's go a little more aggressive on these. So what I'm going to do is I'm going to go, okay, these are set here. Now I'm gonna add a sec just to keep it interesting. So this healthcare. What would be
Maybe
another one?
I'm thinking about the healthcare, maybe because of any development, big development of on life expectancy in the future, or operations with new machines and
Okay.
AI.
So we're gonna go with PE under 20. That's fine, but I'm gonna go a little higher on the growth. I'm gonna be like, okay, who's growing at 20% or better? Gross margin above 50. That's fine. Free cash flow of 5%. Okay, that's fine. So we
I
have
have a
11
question.
stocks. Go ahead.
Free cash flow yield means how much they grow the free cash flow every year. No.
No, it's yield, meaning if they produced $100 million of revenue, they keep $5 million of free cash flow on that revenue.
All right. Okay, I get it now.
It's like interest rate. If you put money in the bank and the bank says your yield is going to be 3% when you put money in my bank, and then you put it in there every year, they're going to pay you 3% on your money.
All right. All right. I get it. Thank you.
So we're going to go more aggressive with revenue, 20%. Gross margin still, over 50%. And then the sector, we know what the sectors are. And we'll leave the free cash flow where it's at because they gave us a list of 11. Okay. So we looked at this one. You may be interested in that one. I'm not sure. I wouldn't invest in it because
Yeah, go ahead.
I wouldn't invest in it because there's just too much risk there. I have no idea if Kazakhstan is a good economy, a bad economy. I don't know if it's a good investment or a bad investment. I just don't know. And I don't invest in things I don't understand. But let's carry on. So the next one here, United Therapeutics. I own United Therapeutics. So this one's matching up nicely. It has revenue growth of 25%. Margins. Look at these margins. 89%. When they produce something, they get to keep 89%. It's almost like printing money. You know what I mean? They just print it out. It cost me 10 cents to print that $100 bill, but now I have a $100 bill. So that's the kind of margin they have. So I've done well with it. It's a good stock. Very good stock for me. I'm glad it's on the list. This one came up. One of our fellow investors on our community, they brought up Lantheus, and I forgot, was it you or somebody else?
No, it wasn't me. It sounds like Enkaita.
Okay. So Enkaita brought this one up. It looks great. I have it on my watch list. So most definitely this one's a good one. And then Halozyme Therapeutics. All right. I don't know this one, so we're going to look at that one. I'm an investor in Catalyst Pharma. I can tell you this is great. It's been doing really well for me, and I'm really glad with that one. Protagonist Therapeutics. Take a look at that one. See, these pharmaceuticals and bioscience, there's a reason why we're seeing this. And this one here, I followed for a long time. This is a good one. Technology is just going to the moon. NVIDIA, Broadcom, just going to the moon. Facebook, Bitcoin. But the investors are forgetting, hey, these companies are awesome. These companies are growing. Look at their margins. So it's not a bad space to look. So that's this screen. I'm glad we added healthcare.
Yeah, that's true.
This could be a good place to be investing because when the world realizes, hey, healthcare's, or I should say biotech, high growth pharmaceutical, that's a great business. And this one here, I know this one is, I'm gonna call it mid cap or small cap. This one's mid caps. Most of these are mid cap, small caps. So those look really good. And then this is pharmaceutical. Let's see if there's anything else. And of course, we looked at this guy here already, but we haven't looked at this one. So let's look at this one. That one looks interesting.
I'm looking at the list, and Protagonist Therapeutics has 100% gross margin.
How is that possible?
I don't know.
Well, we got to look at that one. Jeez. Is it legal? Man. Okay, let's start with Protagonist Therapeutics. Protagonist, a biopharmaceutical company, develops peptide-based drugs for hematology and blood disorders, inflammatory and immune diseases. Okay. Okay, so that's there. 2.45 billion small cap, revenue 323 million. PE is really low. It really high volatility here. Look at that. Wow. But man, in 2 years, you would have been doing great with this stock. Wow, look at that. Incredible. Over the 1 year, 100%.
And the PE, it's only 15.
Exactly. So this is concerning to me, but there's no consistency. But it looks like one of their drugs, they had a really good quarter, but then you look at the revenue, it came back down to like nothing. You see that? 254,
Yeah.
and then 4, and then 4. To me, that's super risky. What happened? Is it a one time like, oh man, they sold a royalty to some big pharmaceutical, and now they're not going to get any more revenue? I don't know what happened there. So we'd have to look into it and understand it. Okay.
Yeah, it looks like it, right?
Yeah. So, and I think the reason why there's 100% gross margin is this is probably for royalties. You know what a royalty is?
Yeah, it's like a patent.
You got it. So you own a patent. It's your drug, but you don't make any of it. But let's say Johnson & Johnson says, hey, Tomas, if you let me use your patent, I'm going to give you money. You're like, perfect. So they just send you money. We don't have any manufacturing costs. You don't have any cost. They just sent you money. So your gross margin is 100%.
Okay, I get it.
So that's what's going on here. All right, this one's a little too weird for me. So maybe some more homework is desirable there. Let's look at Halozyme Therapeutics. What do these guys do? This is biopharmaceutical technology platform company. Researches and develops, commercializes proprietary enzymes and devices in the U.S., Switzerland, Belgium, and internationally. Okay, so $6 billion market cap, revenue is almost $1 billion. Very good valuation. Forward P is going to be 10. Wow. Analysts say it's a buy. They're growing.
I have a question
Yeah.
about analyst and forecast. Who are these people?
Okay, well, I'm going to answer that question. So when you go here, you just go a little further down. Here they are. And what's cool about stock analysis is they give you, like how accurate are they? So you see Jason Butler is probably the most accurate. So if these guys are accurate, like when they say, oh, Broadcom's going to go up, and they said that 2 years ago, they get 5 stars. Like, oh, you're right. You were right. But let's say they were like, oh, this one stock's going to go up and it goes down, then they get 1 star. So
Yeah,
it looks like Jason
rated.
And you can, I think here we can look at, here is his rating of it. He also has other things that he's done, so you can track what he does. So that answers your question, right?
All right, thank you.
Who are the analysts? They're right there. Okay, so back to this one here. It looks interesting. They're growing their revenue. That looks good. This one looks really good. I have in my portfolio, I have Catalyst, United, Pfizer. I'm thinking of adding this company. I'm just holding off from adding it because I feel like, I want to have more cash. But I'm thinking of adding this one. I have a number of them. I think we're kind of clicking on a pretty good space to consider investing in, because these investments, like in the case of Catalyst Pharma, this one's done well, up 60%, right? And look at the fundamentals. P 18, 15, tiny little company, growing. So I'm like, yeah, okay, I'll continue to hold this stock, see it go up.
This one looks good.
Yeah. So this is showing me that, hey, life sciences, biotech, high growth pharma, small, might be the spot that is investable right now. You see how technology, nowhere. There's just like a couple of foreign technology companies that showed up. But this is a stock screens telling us, hey, look here, there's some value. And I can tell you this one's also good. I tracked Harmony, $1.85 billion company, revenue is 681, PE is low, forward PE is low, growth rate's great. It's like, man, these companies look good. They have drugs that people need. So this is a pretty good little space. I'm glad we did this screen because it's reminding me, hey, go buy the company that N. Kiter was saying is pretty good. Then I can have the set. I'll have this one, and this one. So there's your stock screen. Remember, start with sectors that you really like, that you can really understand, and then start, playing with the metrics that mean something to you. In my case, I like seeing revenue growth. It shows me that, hey, it's a company that customers really like. They really like the product so much they're buying more of it, or more customers are coming to them because it's a good product or they're good service in the industry. It's going to produce free cash flow. margins are good, and it's in a sector that I really can understand with a PE that's reasonable. And boom, we got 11 ideas. We kind of work through them, and now can find probably a couple of stocks that we can either follow or even better invest in at some point.
All right. This was very interesting, and I have a few questions.
Go for it.
So, first, I always looked at cash on hand, and I never really understood what it means for the company. I know what it means literally, but either if it is high or low, what does it mean?
The amount of cash they have on their balance sheet.
Yes,
Okay.
it's something that I should care about.
Yes. Well, I think you need to care about it in combination. So let's take a look at the financials. And here's where I would say it's important, right? So this is cash, right? Okay, fine. Now, debt for this company it shouldn't be too much. So total debt is pretty much nothing, right? 3 million. So you see they have 442 million dollars of cash, and they only have $3 million of debt. That means they have a really strong balance sheet. They can buy another company. They can have a bad quarter and pay for all the expenses. They can buy new machinery if they needed it. So it's a very strong company. What you don't want to find is a company. Let me show you an example of a bad balance sheet.
AT&T.
So here's AT&T, and they go, okay, I got $2.6 billion of cash. Okay, how much debt do you got? Well, I only have $148 billion of debt.
Phew.
What? You have what'd you buy? Like, did you buy too many Christmas presents? What's the story? Well, let's take a look at a couple things. So EBITDA, they produce $42 billion of EBITDA. So this is positive kind of earnings before interest, taxes, depreciation. So this has to be under 3 of total debt. But we just showed that their net debt is going to be 145. Well, this is above 3. This is like 3.3, 3.4. That's a big amount of debt. So that's high debt. Should you care about it? Yes. If you have a high growth company, especially if they're young, so this one, maybe this one will show us something like that. This one's also looks good. So what you wouldn't want to see, okay, is they have very little cash and they're cash negative. They're burning free cash flow. Basically, what that means is they need cash because they're going to run out of cash. And if you know what I mean, like I'm showing you companies that have positive free cash flow, but if you had a company that had negative free cash flow and they had very little cash on the balance sheet and they had debt, that's a troubled company. That's a risky company. They may not make it.
Okay, I understand.
Okay. Awesome. Well, I'm glad we went through the exercise, and I'm glad you asked about it. This is how to do it. And investing is kind of like gardening. You don't just plant things and then you go away forever and kind of come back and hope that everything looks perfect. No, you have to continue to tend to it. And this exercise actually helped me because I'm like, wow, hey, first I'm gonna look at open text because I think that looks really interesting. 2, it reinforced, okay, I'm glad I'm in this investment. I'm glad I'm in this investment, and maybe I got to get in this investment. So you see how productive it is. It's like gardening. Hey, great. These plants are doing really well in my garden. I'm going to plant another one because it's really, really doing well. All right, buddy. Well, we'll keep it at that for this session. Thanks again for suggesting stock screening. I think it was an interesting conversation. Any other questions you have before we conclude?
One, but because we didn't find so many tech companies on this screener, I don't think it's relevant, but I would like to know for myself, And you work in software companies before, if I understood correctly. And what do you think is the key metric that we should look when we are analyzing a tech company?
Revenue growth and gross margin. So the give me a second to bring up a stock chart. So when we look at Facebook, right? So Facebook, not too long ago, because they were in the metaverse and they were all in on the metaverse. It didn't work, and they sold off. They were trading at above $300 a share. They sold off, and at the low point, they were selling for $85 a share. But when you looked at their metrics, it's like, wait a second, they have high margins. They continue to grow their revenue, even though the metaverse isn't working. So once they said, okay, we're not going to spend so much on the metaverse, the stock just took off. And now it's up 583%. Awesome. So we're looking for this. We're looking for a business that has high margins, high growth, high free cash flow. That's Facebook or Meta. And they made a few bad decisions. The metaverse didn't work. People don't use it. I have a pair of Oculus headset. I bought it for my son because I wanted to use it. He didn't use it. He's like, yeah, I don't like it. And then I tried to use it. I don't like it. It's like, it puts you it separates you from the rest of the world, and it's kind of not fun. So it's like, I'd rather be doing this, multiple screens, and kind of like talking to people and stuff. So I don't know if the metaverse is ever going to be anything. So I'm glad that they kind of switched and said, you know what, the metaverse is not working. And we're just going to be Meta, the Facebook, Instagram, WhatsApp company, and we're going to make lots of money there. And now they're an AI company. So you get an AI business in Meta. So
the best AI.
Yep. So their AI business is going to do fantastic. They have either 3 or 4 billion subscribers, users of their platforms. So they can roll out AI to 3 to 4 billion people. It's going to be fantastic, in my opinion.
Okay.
And keep in mind that, stock prices are, call it cyclical. You see how expensive Meta is now, right? It went up really nice, and that's technology. The market's expensive. So a lot of people are buying into technology, which is raising prices. It doesn't mean that I have to buy into technology. I'm going to hold technology, but I'm very careful not to buy when stock prices are too high and they're not supported by fundamentals.